A silver shortage just moved from internet rumor to a real-world production problem. Not because people on social media are excited, because manufacturers are getting nervous, and nervous manufacturers don't wait for headlines. They buy first and ask questions later. Here's the trigger. The price in Shanghai jumped far above the price in New York, and the gap didn't get closed. That's not supposed to happen for long. If silver is available, big players normally scoop it up where it's cheaper, fly it where it's expensive, and the spread disappears fast. So when the spread becomes the widest ever and it stays wide, that's the market whispering something uncomfortable. Someone is struggling to get their hands on physical metal, and once industrial buyers believe that story, even a little bit, the buying behavior changes overnight. I'm John A.G., and this is our channel, where we don't gamble, we measure. Now watch this carefully. Most people think a shortage means shelves are empty. That's not how this works. A shortage in a modern supply chain looks like delayed delivery, paperwork walls, rising premiums, and buyers quietly paying up just to keep machines running. And silver is the perfect candidate for that kind of silent squeeze. Because it's not optional for huge parts of the economy. Solar, electronics, medical tech, defense, and yes, cars. The crazy part? A car might only need about an ounce of silver across its systems. So even if silver gets $50, $100, or $200 more expensive, that doesn't kill the car business. But a missing ounce? That can stop an entire production line. And when a production line stops, it's not a price problem. It's a CEO gets fired problem. So what do manufacturers do when they smell that risk? They stop trusting just in time, and they start stockpiling. They fight to be first in line. And that's where shortages become self-fulfilling, because the fear itself pulls future demand into the present. Now, the market evidence everyone's pointing at is simple, brutal, and hard to ignore. Shanghai traded around 92, Euro 8, COMEX was around 83, 32 to 83, 50. That's a massive spread. Historically, you might see 50 cents, a dollar, maybe a bit more during stress. But this is a billboard. And the billboard is asking one question. If Shanghai is paying that much more, why aren't plane loads of silver rushing in to take the free money? Because if metal is sitting around in vaults, arbitrage is easy. You buy here, ship there, deliver, collect the spread. That's what keeps global markets glued together. So if the glue is failing, either shipping is blocked or the metal isn't as available as the paper price suggests. And that's where we have to separate fact from interpretation. Fact, the spread reached an extreme. Interpretation, physical access is tightening. We don't need to claim the world is ending to take that seriously. We just need to ask the right follow-up. Where would the stress show up first? COMEX delivery, because delivery is where paper turns into metal. It's where someone says, no, I don't want cash settlement. I want the bars. And here's what's interesting. January deliveries have been climbing fast. In January 2024, about 1,360 contracts stood for delivery. In January 2025, that jumped to around 2,370. And in January 2026, the number hit about 6,800 contracts, and the month wasn't even finished in the data being discussed. That's not a small change. That's a change of behavior. Now let's translate that into something real. A futures contract for silver is typically 5,000 ounces. So when thousands more contracts stand for delivery, we're talking tens of millions of ounces. The figure being thrown around for January 2026 demand was roughly 34 million ounces so far. Compare that to about 11 million the year before, and about 8 million the year before that. Again, fact versus interpretation. Fact, more people are taking delivery. Interpretation, more people want physical, not paper. And the who matters, because if it's just one weird player, it's a headline. If it's a mix of manufacturers, funds, high net worth buyers, and maybe even strategic stockpilers, then it's a regime shift. And here's the part most people miss. When demand rises in the physical pipeline, price doesn't just rise smoothly, it lurches, it gaps, it prints candles that look like somebody pulled a fire alarm inside the exchange. So if you're waiting for a polite, orderly bull market, silver doesn't do polite. Silver does violent. Let's slow down for 1 second and make the spread concept crystal clear. The spread is simply the price difference between two major marketplaces. It matters because in a healthy market, silver is silver. If one side pays more, metal should flow there. That flow is like water finding the lowest path. When water stops flowing, you don't blame the river. You ask what dam got built upstream. Now, some people hear COMEX and think it's just a chart. But COMEX is a delivery venue. It's a place where contracts can end in real bars, not just numbers on a screen. So when delivery activity spikes, that's the closest thing we get to a live stress test. Because delivery forces somebody to produce metal. And producing metal is harder than producing excuses. Here's another angle that doesn't get enough attention. Industrial buyers don't buy silver because they love silver. They buy it because they cannot ship a finished product without it. So industrial demand is sticky. It doesn't disappear just because the price is annoying. If your customer is waiting on 100,000 vehicles, you don't call them and say, sorry, silver was volatile. You pay the premium and keep moving. That's why small amounts per unit can create huge urgency. 1 ounce per car sounds tiny until you multiply it by millions of cars. Now, layer in electronics. Every phone, every server rack, every sensor, every charger. Tiny amounts, massive scale. This is why silver markets can feel calm and then suddenly feel empty. Not because mining collapsed overnight, because the pipeline got pulled tight by end users at the same time. Now let's talk about the paper versus physical problem without getting lost in jargon. Paper silver is a promise. Physical silver is the thing. Most of the time, promises trade fine because not everyone asks for the thing at once. But when enough people start preferring the thing, the system has to prove it can deliver. And that's when spreads and delivery notices become the smoke detectors. They don't tell you the entire building is on fire. They tell you heat is rising somewhere. And you ignore smoke detectors at your own risk. Here's the mistake most people make. They wait for confirmation from the mainstream financial media, but by the time the media agrees, the move is already expensive. The media shows up after the party starts, takes photos, and then acts like it invited everyone. We don't play that game. We look at leading signals. Now, what would disprove the squeeze narrative? This matters because credibility comes from knowing what would make you wrong. If the Shanghai premium collapses back to normal quickly, if delivery requests drop sharply for a few months, if export frictions ease and metal starts moving freely again, then the tightness story weakens. Possible doesn't mean permanent. And if the story weakens, we adapt. Because we're not here to marry an asset. We're here to understand the tape. But if the opposite happens, if the spread stays wide, deliveries stay elevated, and industrial talk gets louder, then price doesn't need a miracle. It just needs time. And time is what squeezes are built on. Now, let's address the spicy claim you keep hearing. Silver could be double from here. That's not a prophecy. It's a scenario. If physical tightness forces buyers to bid for real metal, the upside case strengthens. If tightness fades, the upside case weakens. That's the certainty ladder. We don't need fantasy, we need conditions. And the conditions are already forming. Now imagine the next layer. A macro shock, a banking wobble, a debt scare, a sudden policy pivot, anything that makes people run toward hard assets as insurance. If that wave hits, while the physical pipeline is already tight, that's when moves stop looking linear. That's when you get the, how is this legal? Candles. That's why the preview matters. Previews tell you whether the audience is about to rush the doors. One more retention beat, because this is where people's brains slip. If silver is just an industrial metal, why do investors care? Because silver has two faces. In calm times, it behaves like an input. In stressed times, it behaves like a lifeboat. And when an asset can switch identities, it confuses the crowd. Confused crowds create mispricings. Mispricings create opportunity. Now, I'm going to say something that will annoy both extremes. If you're 100% convinced silver will explode tomorrow, you're probably overconfident. If you're 100% convinced nothing is happening, you're probably asleep. The smart zone is the middle, alert, curious, and positioned with risk controls. That's where we live. And that's why we keep coming back to the same few signals instead of chasing 50 indicators, because depth beats overload. Now, before we go any further, quick detour. If you also want silver-related success stories, real people, real outcomes, real lessons, there's a link in the description to another channel we like. Subscribe over there too and see how ordinary folks turned smart decisions into serious wins. All right, back to the squeeze. There's a debate happening right now that sounds intelligent but can trap you if you're not careful. People are asking, is the shortage real or imagined? Here's the truth. It doesn't matter at first, because markets move on beliefs before they move on spreadsheets. If enough end users believe they might not get supply, they buy early. That creates the very tightness everyone argues about, and once you cross that line, the market becomes reflexive. Fear creates buying. Buying creates scarcity. Scarcity creates higher prices. Higher prices create more fear. And now you understand why silver can go from boring to insane in a short window. But are we in the final endgame? Not yet. That's the wrong movie. This looks more like the trailer, a preview that shows you the villains, the setting, and the first explosion, but not the full collapse scene. So what would flip this from preview to endgame? Liquidity events. Bailouts. A shock that forces central banks to print hard, fast, and publicly. Because when the system panics, money gets created, and silver reacts like a spring that's been compressed for years. You've seen that pattern in other assets. You know what a limit up week looks like? Silver can do that too, except with more drama. Now watch this contradiction. People look at silver and say, it's tiny, it's not important. And then governments label it strategic. Those two ideas can't both be true, and the strategic angle matters. Because if agencies are authorized to stockpile a metal, that changes the psychology of supply. Even if you never see a press release, even if the buying is quiet. Because the industrial world assumes, correctly, that governments will protect their own supply chains first. And if you're a manufacturer, you don't want to be second. Now add another wrinkle: export controls. A new requirement was discussed where exporting silver from China would need permission. Historically, China has exported silver, but when permissions become required, exports slow down. Not necessarily because the metal doesn't exist, but because bureaucracy becomes a throttle. And in commodities, a throttle is enough, because demand doesn't wait for forms to clear. If you've ever had a shipment stuck in customs, you already understand the emotion that drives this. Now zoom out. We're not only dealing with metals, we're dealing with confidence. Government debt keeps rising. The public keeps getting told it's fine. And yet people can feel the tension under the surface, like the floorboards creaking in an old house. That's where the currency reset conversation enters. And we need to be careful here. In fact, governments are exploring digital currency systems in many places. Interpretation. Those systems could be used to limit how money moves. One risk could be conversion limits. Another risk could be rules that decide what you can buy, when, and how much. And whether you personally believe that's likely or not, the market doesn't need certainty to move. It only needs enough people to consider the possibility. Because when people fear controls, they rotate into things that don't require permission. Hard assets, real goods, stuff you can hold, store, and move. And silver sits right in that psychological lane. Now let's talk like adults. This is educational. We manage risk. So we're not going to scream to the moon and pretend that's analysis. We're going to ask, what's the market paying for? Is it paying for scarcity? For protection? For industrial necessity? Or for distrust in the currency system? Because those are different engines. And when multiple engines turn on at the same time, price can overshoot. Now, you might be asking a very uncomfortable question. If silver is so essential, why wasn't the market already pricing this? Because the silver market has a weird personality. It's small enough to be pushed around. It's liquid enough to be traded like a casino chip. And it's vital enough that the real economy cannot ignore it. That combination creates tension between paper price and physical need. And tension doesn't last forever. It snaps. Here's another thing we should notice. When spreads widen like this, it's a signal that geography matters. Not all ounces are equal. An ounce in the wrong place is basically imaginary for a factory that needs it tomorrow. So premiums rise, delivery times stretch, and buyers start changing behavior. And once behavior changes, the chart follows. Now let's make this practical. If you're sitting here thinking, should I rush in right now? Don't let adrenaline make decisions for you. There's a psychological trap where people buy the first big green candle, then panic if there's a dip the next day, even if the long-term story is intact. A smarter way is position sizing. Decide what you're willing to allocate, then enter in slices. 1/3 now, then wait. Then another third when you've had time to observe whether you still believe your own thesis. Then a final third when the picture is clearer. That approach keeps you rational. It stops you from feeling like you're trapped, because you're not gambling all at once. You're measuring. And if you're already holding silver and you're thinking about selling, here's the mindset that keeps you from doing something you regret. Don't think in all or nothing. If you want to take some profit, consider trimming, not nuking the position. Keep a core. Because if the squeeze accelerates, you don't want to be the person who sold everything and then watched price run without you. Now, let's hit the key question everyone avoids. What happens if this is not just a manufacturing story? What if big money is also shifting toward delivery? Because if funds and wealthy buyers decide the paper promise isn't enough, they can stress the system fast. And you won't get a polite warning. You'll get a sudden surge in delivery requests. You'll get headlines about tightness. You'll get volatility that shakes people out. That's why the early signals matter. The spread, the delivery notices, the export friction, the strategic framing. Each one alone is interesting. Together, they start to look like a pattern. And patterns are how you catch moves before they're obvious. Now, let's create an open loop you should not forget. If silver really is hard to source, why hasn't arbitrage solved it? Is it logistics? Is it inventory? Is it restrictions? Or is it that the available silver is already spoken for? Because that answer tells you whether this pressure fades or compounds. So here's what we do. We watch the spread. We watch delivery. We watch whether manufacturers start talking publicly, because that's usually late. And we watch whether governments quietly increase strategic purchases, because that's usually earlier than the headlines. And most importantly, we watch how the market reacts to bad news. If bad news can't push price down, that's strength. If good news suddenly sends price vertical, that's a spring releasing. Now, I want you to tell me something in the comments. Do you think this Shanghai COMEX spread is mainly a physical shortage signal, or mainly a policy and logistics signal? And second question, if you were a manufacturer, would you risk just-in-time silver supply right now, or would you stockpile even if it costs more? Drop your take below because your perspective helps the whole community sharpen our thinking. And if you want us to keep breaking down real signals like this, without the fluff, make sure you subscribe and turn on notifications. Because the next move in silver won't announce itself politely. It will show up in one number first, and by the time everyone notices, the easy part is gone. And yes, we will track this daily together without panic or hype. So keep your eyes on delivery, keep your eyes on the spread, and keep this in the back of your mind. The moment liquidity cracks again, the preview can turn into the full movie overnight.